Essam Albakr, Riyadh-based private equity. We're a multi-strategy, so we do credit finance and we do VC. My background is entrepreneur, and I've been an entrepreneur for a little bit over 23 years. So I served on various committees, including the SME Development Committee in the Chamber of Commerce in Riyadh, founding member of the Young Arab Leaders chapter in Saudi, and also one of the founding member of the Youth Business Committee in Saudi, which basically we were the early people who really laid the stone for the Angel Network in Saudi Arabia a little bit over 18 years ago.
Good afternoon. Adam Malouf. I'm the CIO for the Knowledge Fund, which is one of the Dubai government's sovereign wealth funds. I've been in the region for 17 years. My background is private equity, funds management and banking. Before this, I worked for a couple of global banks and a private family office. I also sit on a number of external boards as a non-exec director.
Thanks very much, everyone. So I'm going to start the panel off just a little bit more general. Mike, Jeff, you've both had careers that started in your more traditional financial services in the investment banking and capital markets. What shifted you towards venture and venture capital?
Years, and then 2 years ago, I joined them officially. Companies are just staying private longer. Companies are more reluctant to jump into the public markets given all the regulation that's going on, in our case, in the U.S. and in other jurisdictions around the world. So, there's really this opportunity. For me, the other thing that I'll say, frankly, is it's a lot more, it's a lot of fun. Finding these private companies that no one's heard of, and next thing you know, there's a whole new theme emerging. Everyone's saying metaverse now. A couple of years ago, we started really thinking about the metaverse at it, made some key investments there. And it's been really thrilling to do that and be able to share that with our investor partners. The last thing I'll say is from an asset allocation standpoint, the way we're looking at it is you think about the old endowment model and, the Yale model of investing in alternatives. I feel like we're at the next generation of that where perhaps, we've heard about allocators and wealth managers changing allocations where they'll say public stocks are not generating returns, so we're going to put more money into alternatives. Sometimes, to give a better margin of safety, is they'll take some of the money from stocks and they'll allocate it to alternatives and they'll put more into cash, actually. It's kind of an interesting kind of barbell strategy. We're seeing a lot of that, but again, it gets me very excited about the future of the asset class. I'm shot out of a cannon every morning. I don't know if that's evident, but it's something that we like to do, and that's why it's been an exciting change for me, one I'm thrilled about. Jeff?
Yeah, so my background is a little interesting. So I started off as an entrepreneur. I built 4 companies. I sold those companies, and one of the companies that I ended up selling was purchased by a family office, which was under the umbrella of Merrill Lynch back in the mid-90s. Back then, Merrill Lynch Management, or Wealth Management, had a big family office entity. I think it was one of the very first firms on Wall Street that started it. And that's how I got my first job, on Wall Street at Merrill Lynch. So as I kind of went up through my career, which was 21 years, I did everything from being an analyst to being a trader, to running strategy, to actually being on the operating committee and being one of 6 people that ran the business worldwide. So I say that because I had a really good look at where trends were going and where capital was going, and visiting with our largest clients, understanding what they were looking for. And the capital markets, I think, just over the last 10 or 15 years, have become very abundant. And I think a lot of wealthy families, kind of look at that as, okay, that's our traditional stuff, we can do it, but what we really want to have is access to things that are really hard to get access to. We want to be invited to the tables that are very difficult to get invited to. And we want, to be able to identify these great companies that nobody knows about, in the private sector because the public markets, as Michael was saying, have shrunk. And companies are staying private much longer because there's a lot of capital there. And so I decided that in 2016 I would retire and start this firm, which I did. What's interesting is, and I've had a couple of conversations with people, I'm not in Silicon Valley, and that's purposeful. I'm in Miami, Florida. We started our firm in 2017, back when it wasn't cool to be in Miami, Florida. Now everybody, literally everybody is in Miami. But in 2017, I thought that that's where things would end up going. One of my P&L responsibilities was Latin America and the Caribbean. So I understood that jurisdiction very, very well. And I realized, or at least I thought, that companies would be needing to expand through Latin America in order to capture more market share. And I also felt that there was going to be tremendous opportunities for startups coming out of Latin America. If you understand that jurisdiction, it's very interesting because there's no capital markets in Latin America. So what ends up happening is your really wealthy families are multi-generational. You're talking about, 4 generations ago, they were the largest sugarcane farmers in the region. And then the next generation comes in and, they get married to an American because they went to school in America, and, she doesn't want to fly to Miami to go shopping every weekend. So she convinces her husband to take that corner section, we've got enough sugarcane and let's build the mall. And then, the next generation, they build the Mercedes dealership. Where I'm going with this is, in time and where we sit now, there's about 15 families that really rule all of Latin America. And it's a very interesting thing. We're fortunate to have probably 8 of those families. So it's one of our theses is we can take a company and we can launch it through Latin America very effectively and very efficiently and very quickly. So kind of a long story, but that gives you a good taste of why I'm here.
So it's clear there's a load of funding and capital that's being directed towards venture. Adam, Essam, is this something that you're also seeing here in the region? Is this a trend that we expect is here to stay?
Well, unfortunately, for outside companies and fund managers, what they see, they only see capital here. And we're trying to change that perception and have them have a better look at the region from an opportunity standpoint. So we've had on several occasions, we tried to team up with fund managers, mainly European Americans, and their view has always been, this is a region where I can just access capital. For us, no, that's not what we're in the business. We're in the business where we can always work together on seizing opportunities in this region. I mean, when you look at the GCC, you're talking about $2.5 trillion in GDP, which you can access, which you can always scale in. Very young population. We see enough capital in the region that is being utilized to a certain extent for local deals. How to really harness that and really channel it through very good deals in at least in Saudi Arabia sometimes is a challenge, because for the last 5 years we see a growing interest of traditional family offices in Saudi who only invest in real estate and public equity that want to really taste some of that VC reward. And it's more or less baby steps, but as far as Saudi is concerned, we see the government spearheading a lot of that initiative through VC development funds. With SVC, you're talking about over $1 billion. Jeddah under PIF, you got STV, and you have even the ISDB, which is the Islamic Development Bank, having their own VC arm. So institutionals and investors alike, they see the opportunities. At the end of the day, the market is quite nascent, so we've had some very successful stories, primarily in unicorns such as Kareem, and maybe to a certain extent STC Pay, which is actually not a perfect example of a startup. But what we're interested in looking at is exit stories. And that's what really going to attract a lot of the opportunities in the market. So there are a lineup of several technology companies that are going to go direct listing on the secondary market in Saudi. So that is going to be a good opportunity for us to see and even attract some of the international fund managers, which really look at this region based on the limitation of exit. So investors look at entry, hold period, and exit, and what's the value between them.
Adam, I guess from your perspective as well, obviously being part of a UAE sovereign wealth fund, you know, is there a fundamental shift in terms of the focus on startup investing, technology, supporting the ecosystem here?
I think that shift started some time ago when you look at it from the perspective of what support the public sector provides in terms of creating the environment, be it through regulation, concessions, and to some extent direct investment for startups across the spectrum of industries to be attracted to come here, set up, grow, and look at exits. That has started, but it's a partnership, so that the government can only do much and go so far. From that point onwards, the private sector needs to step in and fill that funding gap. We are starting to see signs of that in this part of the world, but there's still a long way to go. And it's needed in terms of, if you look at the spectrum, whether you're talking pre-seed up into pre-IPO, it's needed across the spectrum. So it's not a case of, oh, we need more Series A and Series B. It's everything. And that will mean different things to different types of investors. But the ingredients are there. It's ready. It's just it needs that impetus from both regional and probably more so international investors to take a view that says there are a lot of good propositions here. I mean, we're very long on propositions here, but short on capital. So there's no shortage of propositions to look at. It's how do you get them to stay here? Because otherwise, what's going to happen? They will go offshore for capital. And you lose not only that opportunity from an investment point of view, you lose the opportunity for that entity to actually grow and create value for the economy. But I think it's moving in the right direction, but it's still at a very early stage.
I just want to interject here. I think it's more of the market size and scalability. I mean, at least in Saudi, we're not experiencing that. I mean, you're talking about a deep-rooted economy where you can really scale, and there is industries, mature industries, where you can really tap into those industries, and the masses and the potential of consumer, at least when it comes to, you know, these delivery apps or these various applications that is disrupting specific segments or industries, we see that happening. I don't want to say that Saudi is an insulated economy, but it serves itself very well with its mature industries. And some of that spill over into the regional economies. And there is a specific mandate which is really attracting entrepreneurs. And I personally met 2 entrepreneurs 2 weeks ago that actually left Austria and came and set up shop in Saudi. I think they saw something that no one is seeing, and they're actually scaling. So it does happen. Why? Because it is a virgin market. If I look at other markets such as maybe Western Europe, even North America, it's a bit crowded and the valuation is always a concern. We see a lot of our investors more or less turning away from some of these opportunities, except specific pre-IPO opportunities where they can really capitalize on the short hold period.
I'm going to pick on that a little bit more later, but Chris is the only, call it international institutional investor here that has invested in the region with Karim. What drew you here? What was the interest? And is it what Essam has been saying with regards to this being a captive market, et cetera? Was it the demographics?
Yeah, so I had done business here in the wireless industry. We had built a Nextel version in a little one in Israel, but also in Jordan and in Saudi. So I've had a 20-some-year history of being in the region. Obviously, it's changed considerably. But when we came first to see where it stood, it was easy to spot a Karim, for instance, because there were, if you're looking at later stage deals, there were only a handful of companies that had any significant revenue. And the region has, of course, its attractions. If you look at, sort of think of it as the GCC as the beating heart, it has incredible smartphone penetration, high GDP, an incredibly well-educated population. The consumption of internet is strong, and then it feeds out across a very broad region where you have similar language, cultural attributes, and that region is growing now into Pakistan, and some people consider Turkey, different parts of North Africa. So that, I think, is an easy fit. The trouble with the region back then was it had very few local founders. The Karim founders are not local, but they had a long relationship with the region, and it had a weak venture capital base. And I don't mean the venture capitalists were weak. In fact, we have one of our longtime sitting right here at MEVP. It was more difficult for them to raise money than it was for the entrepreneurs to raise money. It was really ridiculous. And what you've seen, some of the efforts in Saudi, also here in the UAE, you had Mubadala has a fund of funds. In Bahrain, Al-Waha has a $100 million fund of funds. You've seen the VCs now able to spend their time finding great investments and also helping those companies, whereas they weren't able to do that now. From a global perspective, I think the jury's out. There have been some name brand investments in the region by large global VCs. You're seeing them more active. They have not had a series of successful exits yet. To go back to that storyline, there have been exits in the region in almost every path you can think of, whether it was SPAC, public markets, acquisitions. But the global players haven't seen them yet, and so we'll see how long they stick around. It's a little bit tricky to sort through the market. You have, if you look from on high, you see a huge population base. If you get down into the nitty-gritty, you can see a company that's growing, let's just say in the UAE, as mentioned, that's not big enough to attract a global investor. Frankly, neither is Saudi alone, because VCs are relatively simple people, and we like relatively simple equations, and an equation that shows expanding across different countries is the one we like when we're looking at a region like this. So we'll see how far they come. The second wrinkle is that I think the success of the sovereign initiatives in getting funding out there means that there will be some hiccups, because it's virtually impossible to time new money into the ecosystem exactly with the demand by strong entrepreneurs in the ecosystem. So, for instance, at FII, I probably met 25 new Saudi venture capital groups. And there is an inevitable price inflation that's occurring. So there will be some funds that mishit. I think the best funds, those that actually have a track record of bringing value add to their portfolio, will be able to sort through and hopefully win deals based on their value add as opposed to the price they name for a round. But there'll be a rocky road for the next few years, and that could also scare some of the foreign capital. But frankly, I'm not that worried about it because I think those initiatives and the strong crop of local VCs is enough to move the ecosystem pretty far forward. And when those numbers are apparent, the rest of the globe will move in.
It's very interesting, and you pick a couple of points, and I think one of the things that I wanted to ask back is, obviously everyone's been on the tech train for a very long time, and Isam, you mentioned that we want to attract foreign investment into the region, but if you look at a lot of the allocations from the family offices, I'm not talking sovereigns, but the family offices here, and the individuals, as Chris said, the VCs here were struggling to raise money. They were sending the money abroad, overseas, to invest in the US and Europe. So how can we expect foreign investment into the region if we don't have our own, sort of economy supporting it?
Yeah, but I mean, you're looking at a change in the evolution of family offices from generation to generation. You go to the patriarch, he doesn't believe in a VC. The only thing he believes is, oh, you know what? That's real estate, I can see it. See, to him, that's tangible. But to him, investing in an idea, in an entrepreneur, oh no, that's crazy. That's not gonna happen as long as I live. So you see that struggle between the generations, at least across the board in some of the family. I have clients, family offices, and they are some of them very well known. And when you talk to them about VC, they're still reluctant. No. Until someone comes and disrupt the order within that family office or that family, then you're gonna see a lot of changes. But I'm not really waiting for family offices to really come and pour money in it. Traditionally, they're very risk averse, and you see it across the board. But the good thing is, what we see is the government taking a very active role. I mean, you talk about Kareem, I struggled for 23 years. I'm ex-IT, so I used to have a system integration company. So we used to install and implement ERP, CRM, EAMs, and I would go to the bank and say, can you finance me? He said, well, we don't understand anything that you're doing, but the government understands. So we struggled, and a lot of that has changed as things move forward, and you see the government taking a very proactive role, at least in really trying to build this ecosystem in Saudi Arabia. No, we see, on the contrary, we see a lot of positive response from some of the investors from internationally. But if you compare a market that is probably less than 10 years with a VC market in the US, which is 50 years. So if you want to evaluate, let's go back to the time when VC started 50 years ago in the US. You're going to see a lot of trial and errors. So yes, I think the opportunity here is enormous. The demograph helps, the potential, the high liquidity, and the government investing and continue to invest. That really helps a lot.
I think looking more, maybe a little bit at the trends now in terms of round sizes and transactions, we're seeing it, obviously very clearly increasing in the last couple of years. And as you said, Michael, companies are staying private for longer. How are institutions responding to this in terms of their structures, investment vehicles? Take Sequoia as an example. what they're doing. Is that something that you think is going to be a trend that we're going to start to see across the market?
Yeah, I think the lines have been blurred, and as long as everyone's really respects what they know and what they don't know, we think it's a good trend. Sequoia is one example. Companies are staying private longer, but then they go public, and a lot of times there is value to be realized in the public markets. Having this flexibility to do something, in this case growth investing, something that certainly Sequoia has expertise in, enables you to capture that upside in, say, a name like Palantir, which went public at 10 and then traded as high as 40 at the end of last year. Airbnb, which listed at $67.50, doubled on its open and really hasn't looked back, with some ups and downs with the overall market. So, if we can assume that Sequoia can manage beta as well as the average bear, they certainly know how to pick companies, and that's something to be said. Now, this goes both ways, and it goes all different ways. What I'm saying here is that there was the venture capital firms, the guys like Jeff, and then the guys on Sand Hill Road, which by the way, I can't find Sand Hill Road on a map, so and I'm kind of proud of that too. But we've seen firms like Tiger Global come in. We've seen firms like D1, which was thought of as a hedge fund coming out of Viking, and they've come in and become dominant players in these private markets. Certainly the sovereign wealth funds are making direct investments in this region, in other regions. They're getting heavily involved in private investing, to which we say that makes for a really healthy, strong ecosystem. Now, if it leads to some hubris, all I can say is we don't have to do anything. Look, there are certain skills that we have as our team. We can grow our team. We have been growing our team. If we can bring in the right professionals on the private credit side, having spent a lot of my career in the public markets, I can add that to thinking about public markets. So, look, the sky's the limit in terms of how we can do things, as long as we stay true to ourselves and we don't play Icarus flying too close to the sun so the wax in our wings melts. So I think it's an exciting trend. As always, we have to make sure that we're not getting too complacent.
I don't know if anybody else has sort of a different view in terms of how the, I guess, investor mentality is also changing as the space is evolving.
Yeah, I'll jump in just because, when we were talking about Saudi and what's happening here, I just trying to be a good listener myself. I'm domiciled in Miami, as I mentioned. And right now in the United States, you're seeing a tremendous amount of entrepreneurs, investors, everybody's kind of coming to Miami. And it's really an outcome of what happened in COVID. People realized, hey, listen, I can work from anywhere. Why wouldn't I want to work somewhere very nice? And Miami has been, a benefactor of that. But I get asked a lot on television or, different reporters that ask me literally almost every week, how do I feel, is it sustainable? Is it gonna last, et cetera? And it kind of piggybacks to what we were talking about here. And what I always say is, if you really understand what Sand Hill Road was and what created it, it was the community that came together. It becomes a family, and it just keeps moving around the circle. And without it, the clock never starts to tick. And that's what I've experienced, in seeing this massive change in the last year and a half, really from California to the East Coast. And I see no reason why that wouldn't, be everywhere. And I think that the other thing that I'll say is information's been democratized. And creators now realize they don't have to travel to the United States to be a successful entrepreneur. They certainly don't have to go to Silicon Valley and live in a closet and pay $10,000 a month to live there. You can be anywhere that you want to be nowadays. And I think that, I look at this city here and I say to myself, my God, this is incredible. And in short order, there's going to be entrepreneurs everywhere because this is a city that is state of the art. I mean, if you want to, to me, I walk around here saying to myself, I want to have an office here. So, I think it's just a matter of time.
I just want to add something to what Jeff said about family offices. family offices are becoming a threat to fund managers. They've become very sophisticated. They have their own teams in place. They're not after manager selection anymore. They're actually going after the deals direct. Now it's just more building relationship. Can we co-invest with you? And we see it. I mean, I notably see maybe 2 or 3 family offices. They used to have, like probably 7 or 10 years ago, a private equity where they used to club their investment. They shut it down. Now they manage all of their investment, private equity, through their in-house team. So family offices are becoming more sophisticated to the degree that they can source their own deals, they can deploy, and they can manage. They don't need fund managers anymore. All right, we don't see it across the board here, but we see pockets of it happening at least in the region, and you can see it visibly in the US at least, and also to a certain extent in Europe. And they have access to deals better than even the fund managers. And that is the challenge, because the paradigm is changing. The dynamics on the ground is changing. So how does emerging fund managers or seasoned fund managers can really navigate the changes that is happening within this market, especially at least within the VC sphere? And I think building those relationships with family offices is very important for us going forward, because as their risk appetite changes and evolves, they become more independent, so to speak. And they say, you know what, I'm just going to do things on my own. I don't need a fund manager to charge me 2 and 20. And you know, normally we used to get scared from institutional investors because they want discounts, they want rebate. Now you got family offices even asking for a small ticket, but you need them because their name is very important and they're going to bring others. So this is at least what's happening on the ground here.
Do you think that means that asset managers now need to start looking to different pools of capital in order to continue to exist?
Not necessarily. I mean, still the capital is there. It's just a matter of, you know, there's just too many players. I mean, what we see, at least in Saudi, and I think maybe Chris can probably agree, the emergence of a lot of fund managers. And that's very good. A lot of them are going to succeed and some of them are going to fail. Not everyone. I mean, you know, most of these funds, you know, I would expect in a couple of years they're going to go on triage. I mean, or they're going to turn in zombie funds, because still, unless you can perfect that exit strategy, the exit story, the exit scenario, and that's what you sell to your LPs at the end of the day, you're still going to have a problem. But the capital pool is there. But I can't see that a lot of the family offices, bear in mind, at least in this region, the market is still nascent, so there is enough room for everyone to play and you know, and make money. Yeah.
As a sort of allocator to asset managers, what are the key things that are important to you when you're? Is it their track record? Is it the exit, or is it more specifically what they're doing, and in which markets they're playing in?
Well, inherently it's about the track record and their performance, but it's also about their outlook on the market. And when we look at asset managers from an allocation perspective, you know, we don't go to, you know, the usual suspects, if you want to put it that way. We take a very flexible approach to that, because for us it's about achieving the objectives, the parameters that we've set as a sovereign fund. And that may not necessarily be achieved by going to, you know, large institutional fund managers. And you know, to Sam's point, family offices could potentially provide a source of those management capabilities. Because if you look at them, they are like mini investment banks. I mean, I worked for a multifamily office 10 years ago here, regulated in this centre, and it was like any other fund manager. And that was 10 years ago. Fast forward, there's a lot more of those types of shops that are being established, either from scratch or off the back of traditional family offices that are looking for greater efficiency in the way that they operate and also to play in a different space.
Think to the Sequoia change in strategy. I think they just really want to keep the capital. I mean, it's not really. I mean, there is pressure. This is an open-ended fund. So at the discretion of any LP, they can redeem. I don't know what is the time frame for them. Yeah, quarterly, yeah. So, but for them, they just really want to keep the, because it's still getting very crowded, at least in North America, for you really to chase that capital. So for Sequoia being the godfather of VC, you know, it's for them. I mean, I'm a little bit skeptical about this strategy. It's a hybrid between, you know, public equities and VC. So you're wearing hats at your convenience. But at the end of the day, it's for them to preserve that capital and keep it at bay.
Well, in that business, you know, coming from the AUM business in the United States is worth a lot of money. So from Sequoia's perspective, you know, they're identifying these companies, they're curating these companies, they're exiting these companies. Why in the world are we now going to give it to Goldman Sachs or Merrill Lynch or, you know, UBS or whoever it might be? And so what they've done very, very smartly, in my humble opinion, is, you know, they've changed to a registered investment advisor in the United States, which gives them the ability to legally make these trades. And ultimately, these individuals who have entrusted their capital with Sequoia, you know, they have absolutely no reason or want to take it elsewhere. So for them, really, there's a couple of aspects to this. Sequoia is understanding that their investor trusts them very much and really doesn't want to cut the cord. And these companies are now public. You've known this company since it was maybe an idea, but it was certainly an early private company before it became public. You know the company better than anybody on the face of the planet.
But don't you think this is going to start a trend? I mean, think about Horowitz. They've already registered as an advisor. And you have a couple. Is that going to start a trend by most of the VCs going that route?
Absolutely. And so if you're thinking about that, again, coming from that world, you know, if I'm a wealth management business in the United States, I'm getting really nervous because you see so much capital that's going to the private sector, and now you have these large firms like Sequoia and Andreessen, quite honestly, anybody, right? I mean, even us. I mean, you know, we're close to $1 billion. Why do I want to exit those companies and then now feed it into, you know, another firm? Why wouldn't I want to keep that myself? Because it's worth a lot of money. I mean, the average registered investment advisory firm in the United States is trading about 150 to 160% of its AUM. Start to think about that. Private equity firms are buying them up left and right.
You know, the proof's going to be in the eating. You know, as Essam pointed out, everyone is getting into this. This is all happening. Again, we all have to watch out for the hubris, and the proof is going to be in the eating here. Let's see how everyone does. You know, I don't think any of us here on stage or anyone in this room really thinks that we're never going to have a stock market correction again. All it's going to take is one of those, and everyone's going to say, there we go, you know, this is why we shouldn't crowd into things, and we should all just give our money to Vanguard or trade ourselves on Robinhood in the US, and that's it. And everything's going to go in cycles, and there'll be a lot of that. The way I'm looking at that is, look, things get overcrowded, it does create opportunities. The dysfunction does that, so.
So what I see, I mean, when you have Sequoia, and eventually you're going to have Horowitz, because they registered before that.
Sure.
Is that going to change the way we perceive VC as a long hold exit? That's going to change a lot in the dynamics of how investment is done, at least in the US, because they're leading.
It's going to really depend upon those market players. Let's watch Sequoia, let's watch Andreessen, let's watch Fuel and Addit, and the rest of us in all of what we do? Do we think we're just going to be smart and start flipping stocks and act like 0.72 or some day trader here? If so, then maybe that's a bridge too far and not what people intended. But let's see what really happens there. I think flexibility might be a different game than that. But let's see. Your caution is warranted.
I agree, the caution is warranted. But again, as things change and firms and the smart people behind them iterate, it's just a different division, isn't it? I mean, if I'm at Goldman Sachs and I'm on the wealth management side, or I'm on the investment banking side, or I'm on the trading side, or the derivative side, it's just a different division. And so, if I'm an investor and I'm looking at Sequoia, I'm looking at Sequoia because I think they're a great private market identifier of talent, and they've got a great track record. And again, they know these companies better than anyone on the face of the planet, so they probably have, and they're going to stay, connected to these companies. So they probably have the insight on the buy or sell versus whoever I've turned it over to just because it's a public company.
I mean, they're not going with their Indian fund and their Chinese fund. So they're holding back on those. So they're focused on the European and the North American. I'm not sure even if their model is 100% proof, is it going to really pan out the way they want? So more or less it's going to be a time will tell whether they will succeed in this model, and everyone else is going to emulate that.
I mean, it's only natural to have that evolution, right? I mean, at the end of the day, what difference, Sequoia as an investor, what difference is it of them holding the stock once the company is IPO'd versus the original founders of a company or a family that started the business, right? You could argue that they took it through that growth, so there's no reason why they wouldn't continue to hold it, potentially. Just putting it out there.
No, I agree.
We're talking about exits and full circle, and I think maybe this is going to be the last question that I'm going to ask. SPACs is something that everybody is talking about or was talking about, and I'd just like to get your views on it. What do you think the evolution of the SPAC market is going to look like? Maybe, Chris, you can.
Happy to jump in. I'm on the board of a couple of SPACs. I think that, it's just another path, and it's a little bit nascent. We have a boom in formation. We may have a lag in actual success, and there'll be a shakeout, but I think from the regulatory structure and the way the vehicle works, it's a reasonable alternative to exits. We've seen a couple of them in this market. While there is fairly heavy SEC scrutiny, as they take on their acquisition target, it does give a little bit of time to prepare a company for public market scrutiny that they wouldn't have when they do an immediate IPO. And so I think there'll be some shakeout in the people who poured money into the initial name brand versions that may not end up with a name brand acquisition, but I think it's a useful vehicle.
Yeah, if I may, Addit has, we did sponsor our first SPAC in January. We're working on targets. Can't really say much more than that other than stay tuned. The interesting thing about SPACs is, when it's a lot of, the thing that we always look for, the thing that I'm proud about with our SPAC is that, we have, it's not just financial types and venture capital and financial sponsors on it. We have practitioners, successful entrepreneurs in education technology, in financial technology on our team, and I think that's the big watchword. The other thing I'll mention, admittedly, is that while the SPAC market is still operating, the PIPE market, which helps finance de-SPACs when a deal is to be done, has become a little bit log-jammed. And a lot of the big U.S. institutional investors are more reluctant to put capital to work there because they've done a lot of deals that haven't gone quite the way that they had hoped. They haven't, maybe not failed, but they haven't produced the returns they wanted. So there was a little bit of overbuying there. We're conscious of that. We're looking for that. We're not looking to force anything. We still think this is a really important financial instrument for years to come.
Yeah, so our firm also has sponsored a SPAC And again, we are also working on our target. We're under a letter of intent right now, and hopefully we'll have the definitive agreement public here in the next 30 days or so, and we're super excited about it. So, you know, I think it's like anything that's out there. I think when you know, entrepreneurs and people who are chasing, you know, wealth creation, they see an opportunity to do so. And we've seen a lot of that, right? We saw kind of a big peak. I've always said that when, you know, you start seeing people, you know, on the field that really shouldn't be there, you know, the SEC comes in and tightens things up, and those individuals end up leaving, you know, the field, and it's left with people who really have solid teams and know what they're doing. I concur with what everybody has said here today. I don't think it's something that's going away. I think it's important. And I think that it's people like us in the private sector that actually came from the public sector that really understand, you know, how those mechanisms work. I'll share a quick story because I know we're running out of time, but you know, when I started on Wall Street in 1994, there was a little tiny company called Amazon, and everyone in New York made fun of this company. Who in the world is going to buy books online, right? If I'm going to buy a book, I'm going to go to the store, I want to smell it, I want to read it, I want to touch it. You know, Amazon went public in 1997 after 3 years of being private. It had top-line revenue of $15 million, and its valuation was $300 million. You fast forward to 2021, I don't know where it sits, you know, when the market opens today in the United States, but it's somewhere around 1.6 trillion. So the point there is, from 1997 to 2001, you know, multi-generations of wealth were created by people who invested in that company in the public markets. You fast forward to 2019 and you think about the most iconic IPO that we've had, it was Uber, right? Everybody was talking about it worldwide. Uber was private for 11 years. It had top-line revenue of over $1 billion. When it went public, it was $74 billion in market cap. And it hasn't made a penny for anyone in the public markets to date. The multi-generational wealth was all created in the private sector. So if you come from our world and you can identify great companies in the private sector that you know have a tremendous amount of growth trajectory, and you have some core values around what you're doing and you're trying to give back, I think it's people like us that are going to really shift and put the power back into the public investor who has really been missing out for a long time, because I think the markets have forgotten what our job is. It's not about, ringing the bell and getting the absolute, most penny out of it at the IPO, and then ultimately the investing public, suffers. And so that's what I'm excited about with respect to SPACs, and where I think things are going with individuals like the three people here who are on this stage, and that's what I'm excited about.
Great, I think we're out of time.
My opinion really about SPAC really is no different than what Chris earlier said. It's a useful alternative tool for exit. It has its flaws, but you don't hear the stories about it on, the value of the stock, some of the failures of some of these SPACs. But from a regional perspective, it's a very useful tool for a lot of the companies here to access capital, at least in other markets such as the US and Europe to a certain extent. And that is more or less the conduit that they can use in really accelerating the exit rather than just going through an IPO, even though that direct listing is a much cheaper way of going IPO, and we see it being utilized heavily, at least in Saudi, with the secondary market.
Just one final comment. I think the benefit of this region not having its own regulations around SPACs is actually good, because we are looking at what's happening in the US. We will take what's best practice we will factor in how the regulators react to this, and this will happen. They will tighten the screws. And then when it comes to actually implementing them here, which is now happening in Abu Dhabi with the ADX, then we will have a mechanism which is fit for purpose generally and has been adapted to the region. And it will work well in terms of providing that exit option for those companies here who would otherwise go to the US or go to Europe and the UK.
I just want to say, because I think it comes full circle, I love what you just said, and I think it's a great investor insight. What you're basically saying is, let's wait and see what the U.S. does, and we'll figure out where they go wrong, and then we're going to be able to catapult because we aren't going to make the same mistakes. And I think that's important for everyone who's thinking about investing in this region or Latin America or wherever it might be. That's the opportunity, because you have the ability to exponentially leap forward by understanding what maybe the market leader has done. And that's one of the things that we are looking at all the time. It's exponential, but you're absolutely right. That's exactly what you'll do, and it will be very successful for you.
Do we have any questions from the audience? Thank you very much, everyone.
Brilliant. Thank you so much. And as always, our speakers will be available outside for a quick chat if you do have any more personal questions. We do have a very short break now, literally just 20 minutes.